Hey everyone, welcome to today's show on Wealth Strategy Secrets. Today we're joined by Ted Lanzaro. Ted is a highly recognized and respected CPA, real estate investor, and real estate broker. He's the founder of Landmark CPA Group in Fairfield, Connecticut, a boutique CPA firm specializing in accounting and taxation for the real estate industry. For the past 31 years, he has helped thousands of real estate business owners, entrepreneurs, and investors all over the U.S. implement cutting-edge tax strategies that save them thousands of dollars annually on their taxes. Ted also runs the Lanzaro Commercial Investment Group at EXP Commercial, which does investment acquisition and disposition for real estate investors and private equity firms, as well as his personal investments and syndications. Ted, welcome to the show.
Yeah, thanks, Dave. Thanks so much for having me. I appreciate you having me on today.
You bet. Really looking forward to this conversation. And look, it's, we're just about in October of 2022 as we record this. So taxes are definitely forefront on people's minds, as they look towards the end of the year. How can they prepare themselves and optimize for 2022, as well as, get prepared for 2023. So really appreciate you coming on the show, and maybe we can just kick things off with telling the audience a bit about your background. How did you, I'm actually from Connecticut myself, so I know exactly where you are. But tell the audience a little bit about your background, how you got into, taxes, investing in real estate, and how did it start for you?
Yeah, so it's kind of interesting. I grew up in Stamford, Connecticut. When I was a kid, my mom and dad moved us down to the Boca Raton, Delray Beach area of Southeast Florida, and that's where I started my real estate investing career. When I graduated from college, I went to work for a CPA firm there in town, and I was basically putting in a lot of hours and learning the business. And I was primarily working with real estate clients, high net worth developers and builders, home builders, because that's what there was in South Florida at the time. There was basically tourism, farming, and real estate, right? And those were the primary economic drivers at the time. So as I moved through and started getting more experience, I started realizing, hey, these guys are really making money. Some of these guys are doing, and we're all in the syndication business now. I was doing syndications for basically shopping centers and industrial buildings back then. Even as this goes back to the early 90s, right? So fast forward to about the year 2000, and a friend of mine from high school approaches me and he says, man, you got to read this book, Rich Dad, Poor Dad, right? This is a book that's launched, like all these investment careers, right? So I'm like, I look at it, I says, I said, yeah, I says, I said, I'm telling you, the guys that I work with, they're really making money. We should definitely get into this. And about a week later, we went out to look at houses in Fort Lauderdale. We ended up putting 3 houses under contract that day, right? And that was the beginning of like our real estate investment career. We basically were using the buy, fix up, and rent model that has become pretty popular. And so those were our first three deals, 3 single family houses. I think a lot of people start out that way. Well, after over the next like 2 years, we ended up buying something like 60 units, because we ended up buying a handful of more single families, and then we bought 3 garden apartment complexes, 12 to 18 units each. There's a lot of those down in Southeast Florida, and we got to about 2005 or 2006, and I was like, I was telling you, the 2005, we ended up having a couple of hurricanes, and I wanted to basically go back to Connecticut. I had just had my first son, and so I was like, so what ended up happening is that was about the same time that the mortgage, everybody, if you could fog of mirror, you could get a mortgage, right? So quality tenants were getting harder to find, but good buyers were, and pricing was going through the roof. So we ended up, as we exited the single families, we're able to sell them at a pretty nice price. I ended up selling my piece of the apartment stuff. I think my buddy still owned these apartments, by the way, right?
Right.
So they bought me out. But during that period of time, I started networking and going to real estate investment club meetings, right? Somebody found out I was a CPA, and they were like, "What tax strategies are you using, on your own investments?" So I started telling them about it, and they were like, "You need to get in front of the room and talk about this, for our group." I had never done a presentation before, and literally this is the first time I had ever done it. I, got up in front of the room, my knees were knocking, and I, spent the next hour, reading off of my PowerPoint slides, right? And but at the end, everybody clapped, and I got a few clients, and I was like, okay, well, this is kind of interesting. Fast forward to today, I probably do 2 or 3 dozen presentations a year, webinars, live stage, talks to real estate groups. So it's actually become almost second nature, but back then it was scary, right?
Sure.
And then somewhere during that time, cost segregation became a big thing, and I remember one of my partners had a partner for a while, and he was part of the group that testified in front of Congress as to what these depreciation rules would, what economic effect would they have, what effect on the real estate industry would they have, whatever, when they implemented these cost seg rules, right? And back then, the big thing was you were breaking up like on a shopping center or whatever, you were taking a 39-year asset and bringing it down, and to some of the pieces down to 5 years or 15 years, and people thought that was amazing, right? No, nothing about bonus depreciation, right? Just, hey, we're going to be able to take 20% of this building and depreciate over 5 years instead of 39 years. That's amazing, right? So it was really, like kind of a very interesting strategy. Now everybody's like, oh, bonus depreciation is going away. We've all gotten a little spoiled, right?
Yeah, no, that's a really great story of how you got into it, Ted. I always find it fascinating. Almost everyone in the space took that purple pill and read Rich Dad, Poor Dad or the Cash Flow Quadrant. That was the same for me. And, it was really so insightful in terms of really, understanding how money works, right? Because nowhere, is that concept taught in any educational, fields or anything. So once you kind of learn that and you get your head around it, it's quite powerful. The next trick, though, is trying to put it into action, which takes some work.
Right. And what I always thought was the most interesting, and to this day, this still happens to me. So in the book, he talks about looking for opportunities, and if you have a kind of an opportunity mindset, you're going to be looking. So to this day, and it's been a while, and so after when I moved back here to Connecticut, I started basically just like flipping houses, and I was also like renovating multifamilies, stabilizing them and selling them, but I really didn't want a landlord anymore. So my business was more, find, fix, stabilize, and flip, right? But what that book taught us was every time I pass a crappy building, I'm like, oh, what's that? Or if I see an empty building, I start thinking about what could be done to that building, right?
Right.
And so it's like that mindset of looking for opportunities. And the same thing from a business, because the book, business wasn't all about real estate, it was about businesses too. Like when you see an idea or you see something that needs a solution, and you feel like you could provide that solution, starting that business. So that was the genesis of my commercial brokerage, was my client saying to me, hey, we can't find properties. at a time when I was finding properties and buying properties and flipping properties, right? So I'm like, I'm using my broker's license to do this for myself. Why not start doing it for other people also, right? So, and it started small. It started basically just sourcing, small multis and stuff for people, small single family houses for them to flip. And it's turned into now where we're brokering a handful apartment buildings. We're helping people find buildings. I've got right now, I've got 3 mobile home parks, a portfolio of mobile home parks that we're marketing for a client. So it's that book was amazing from the standpoint is it taught you how to recognize opportunities to make money, not only in real estate, but in business also.
Yeah, absolutely, Ted. And one of the big insights I gleaned from that as well was that the top 1% are really aligned to the B and the I side of the quadrant, being a business owner, right? And then also an investor. And in that sense, you'd be most optimized to take advantage of taxes. So, when I read that and understood that, I was looking for opportunities to, become a business owner, become an investor. This all started for me in about 99, 2000, also when the book had just come out. So I shortly thereafter started a business. And, being a business owner is where I really learned about taxes. I learned about them also as an investor, right? Getting, depreciation benefits and such. But as a business owner, I really struggled, right? I built 3 companies over the past 20 years. And I went through this journey where I knew there was some type of tax nirvana out there. Like I was just determined to find it. But I can tell you, Ted, I literally fired 5 different CPA firms over the years. We worked with some prestigious firms, and the checks that you wrote to them got bigger and bigger, but the results were always the same, right? And I find that the majority of the industry is really looking at taxes in the rearview mirror, saying, give me all your statements, tell me what you did, this is what you owe. And I had 2 really big frustrations. So number one was not understanding what my taxes were at the end of a year, right? What my liability was. So how could I plan a business? And then, you'd get crushed in cash flow, come April time when you had to pay. And secondly, no one really proactively created a strategy for me around my taxes. So again, I went through this journey of going through all these CPA firms until I finally found the right one that really understood, business owners and investors. And we could then create a, proactive strategy around, building wealth and how you take that forward. So can you tell us a little bit about why is the industry like that? And also Tom Wheelwright's book was, such an eye opener for many of us, right? To realize that the tax code is really 6,000 pages of, it's a roadmap of incentives for business owners and investors who understand how to utilize it. But if you don't understand how to utilize it and position it, then, you're really just paying your taxes like everyone else.
Yeah, I mean, so that's that's another great book. Tom Wheelwright's book is very, very good. I can't. I was fortunate that when I started, I had some really good mentors who, taught me tax planning. Right, like the first CPA I ever worked for, he was really big on tax planning, and it taught me the proactive side of the business. I think a lot of CPAs make a living literally putting numbers on forms, but the ones that have the ability to look at situations and say, hey, look, if we're proactive about this, we're going to save you money. So I'm telling people all the time, right, that the key to tax savings is to be 2 things: proactive and granular, right? Because I think I think they go hand in hand, because if you don't have, and by granular, I mean keeping good records, right? Really good records. And so if you don't keep great records, then it's very hard to be proactive because you don't know what your numbers are, right? So I'll just give you an example. So we just got done, I just got done with the September 15th deadlines, right? My partner works on most of the personal returns, but I do all the hardcore planning. And that's what we're doing now. So right now, and all during the year, but specifically right now, we're looking at our clients' numbers, all of the business owners, and saying, where are you at as of the end of August? Where are you going to be as of the end of September? Right. And throughout the rest of the year, all I'm going to do is tax planning. I'm going to put things in place during the year to help my clients save money come April 15th, because most of the stuff that, so you're right, most of the good tax strategy happens during the year. And from a real estate investor, so we have a thing we call year-round tax planning, right? That's what we do for a living. I'm not a tax preparer. I'm a strategist, and we do year-round planning with our clients. And I'll give you an example. I tell my real estate clients, I need to know before you buy, before you sell, and before you renovate a property. And the reason I want to know that is because there's things, one, there's a whole bunch of strategies I'm going to help you implement on all three of those things. But also there's going to be things that I'm going to need you to do while you're doing those things in order to safeguard. So it's not just about putting the strategy in place, it's safeguarding it, because sometimes, and in a lot of cases, you're taking it, you're working that roadmap that Tom Wheelwright talks about, but you also need to be documenting the things that you're doing so that if ever does get looked at, you say, well, here's my backup. Yes, I'm taking real estate professional status. Here's my log of hours, right? Or here's the before and after pictures of this renovation that I'm doing. Here's all the stuff that went in the dumpster. You can see that that stove that was there in the before picture is not in the after picture. I threw that stove away, therefore I'm entitled to deduct it, right? So, if I haven't already fully depreciated. So it's all of those kind of things that we're talking about with people all during the year, and encouraging our clients to be, communicative. That's the big thing, is to get them to tell us what they're doing. But that the planning is where all of the tax savings comes from, and all of the wealth building, right? Because we're looking at people's situations and saying, hey, if you do this, now you're going to be able to save some money. Now you can put some money away. Are you making sure you're maxing out your retirement plans, for example, right? Even the self-directed ones, because people I've got a lot of clients, I've got so many real estate investor clients that they're like, oh man, I don't want to lock my money up in the stock market. No, self-directed. Right? You're still building wealth, you're still putting that money away, you're still getting the tax deferral, right? So it's all of those kind of things that we want and help people do during the year that save them, that ends up being the reduction on their bill on April 15th.
Yeah, absolutely. And I think another real key piece of advice is, part of this journey is really taking, not only being proactive and having a great CPA such as yourself, right? That looks at things, does planning on an annual basis, like you say, but a lot of this is awareness, right? And, when you look at the top wealth destroyers that are out there, taxes are number one. Right. However, no financial planner or no one talks about, okay, if taxes are your number one biggest wealth destroyer, what are you doing to mitigate them? Right. What are you doing as part of a strategy? So part of this is taking an active role yourself and understanding the taxes and the strategies, just like you were talking about, so that anytime you do something, you structure it in a way that's favorable, right, to you. So I think about, even on a daily basis, whether, whether you're going to buy a new vehicle, whether you're going to go on a vacation, maybe you can tie that into, a business trip, or, we've talked about going, internationally, and we have an international real estate property, right, that we go to, right? So we get some advantages that way. But I think it's really important for people to take an active role and have some ownership, in your taxes if you'd like to reduce them, instead of just, waiting, every year and then sitting down with your preparer and again, having them prepare your taxes. You want to be active with.
Right. Yeah, no, you absolutely do. And you brought up a good point, which is that whole idea behind um, creating situations where things that you're going to do and going to spend money on anyway, you figure out a way to give a business, but if you're a business owner, you figure out a way to give a business purpose to so that you can deduct some or all of it, right? And it's not just looking at it from this year, right? So I'll give you an example. I was in Charlotte in June speaking at a conference, and what we were talking about is where is everybody going to be when the deals that you're taking bonus depreciation on in 2021, 2020, 2021, when you go to sell those deals in 2025 and 2026, and bonus depreciation doesn't exist anymore, where are you going to be? And I made a comment that everybody kind of laughed at, but it was a serious comment, which was, I bet you there's $100 million in deferred bonus depreciation just sitting in this room, right? So what happens? So we're with my operator client stuff, we're already looking at that stuff, right? Now we're developing a plan, right? Because we don't really know what the code is going to look like then. I mean, so we have to develop the plan based on what it looks like now, but what it looks like now is pretty bleak. Looks like people are going to be paying a lot of taxes in 2025, 2026, 2027. So how do you go about mitigating that? How do you start thinking about that scenario? Where all of these 2021 syndications that run their 5-year, typically their 5-year course, right? When you can't turn those and then go just put your money in another deal and get the bonus depreciation to offset the capital gain, where are you going to be? Right now, there's not a great answer for it. So we're talking with our clients about, hey, this is what this is going to look like down the road. This is how much money you may need to have down the road, right? But also looking towards, okay, now what things are we going to be able to do and put into place for those years to try to minimize that? So it's short term and long term.
Yeah, no, great point, Ted. And maybe you can elaborate a little bit, because I know there's a lot of confusion out there too in terms of depreciation recapture. Can you just talk about the structure of how that works?
Yeah, I mean, look, it's complicated. I mean, it is reasonably complicated, but the basics are that the bonus depreciation, if you're a real estate professional active in deals and you're taking bonus depreciation against your earned income, right? Or and you're taking the deduction for it, it's not a complete wipe. It's not a wipeout of the of any tax liability like a 1031 exchange would be, right? It's a deferral, and it's a deferral until you sell the property, at which point you have to recapture. So if you take $100,000 of depreciation against your earned income in 2021, for example, and then the deal sells in 2026, you've got to pick up that $100,000 of recapture. That's the basics of it, plus any gain you have on the sale, right? And what people have been doing is they've been doing that with their syndications that are coming that they're selling in 2021, but they've been doing it with new deals. The bonus depreciation on new deals that won't be there then, right? So the thought process is, okay, well, do I have a plan for that? And part of that plan is accumulating some dollars in case you have to pay the taxes. And the other part is, trying to figure out, okay, well, if I'm still in the business, if I'm still doing this business, then, well, I'm still going to get regular 5-year and 15-year regular depreciation on my new purchases. I just won't get that big bonus hit. how is that going to affect it? How much more property do I have to buy? Because we typically will tell, like, I'll give you an example. If somebody has to defer $1 million gain now, this year, let's say they sold something in 2022, they've got to defer $1 million gain. Okay, go and buy a $5 million property. Go and buy a $5 million apartment building, right? 20% of it, give or take, is subject to bonus depreciation. You get $1 million worth of depreciation on it, it offsets $1 million gain, and you're at net zero at that point, right? Okay. Well, if you're talking about that same scenario in 2026, it's a completely different story. Now it's either, well, we're going to do the identical strategy, but it's only going to defer a couple $100,000 of it, or you're going and buying a $20 million building to be able to do that, right? That's a big task for anybody. I mean, that might not even be possible for most people.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com. Good point. And do you have any other strategies that you could recommend? Because we have a lot of, business owners, right, that have done exits and are looking at large tax liability this year. So any other strategies you could recommend?
Yeah, I mean, for the business owners, it comes down to, what their situation is. So we're always looking to try to, if somebody sells their business, for example, right, then what else can they be doing to get their other income down, right? Because you want to get, and so ideally you would sell your business in a year where you would have the lowest possible everythn else. And if you're trying to develop an exit strategy in advance of that, right, then that's what you try to do. You try to minimize everything else, right? But as an alternative to that, right? So just to give you an example, I have somebody who's coming out of a situation where they're selling stock in a bit, they sold the stock of a business that they helped develop, and now they're getting out of it. Well, but they also just took a $700,000 bath in the stock market, over the last 3 months with, because they were in a situation where they were kind of heavy on margin, and as the stocks were coming down, they had to get rid of stocks to cover their loans, right? So they ended up taking a $700,000 bath. Well, now we're going to use that. Right? Okay, it exists. It sucks, but it exists, right? So now that is part of the offset of that situation. It would be the same thing as trying to use where there's not a direct offset of bonus depreciation against a business capital loss, but if you can offset, if you do qualify as a professional, you're active in a deal, then that's just another kind of income that you can use to offset. By buying real estate, you can use that to offset whatever kind of income you have, even from the sale of a business that's not real estate related. Right?
Yeah. And what would you feel about an opportunity zone?
I like opportunity zone, but the thing about opportunity zone right now, right, is that, so there are other strategies. So like with the real estate, you can use 1031, you can use opportunity zone, you can use opportunity zone on just plain old anything, right? The business, one of the coolest things that I've seen recently is this whole deferred sales trust, right? It's the different DST, right? And so you can sell a business and put the proceeds in this deferred sales trust, assuming that you're willing to give up control of the money, right? And then it's like a 1031 for business, basically. I mean,
right.
That's the basic concept of it, right? And then you can kind of ease the money out and pay taxes on it as you want to. So if you need a couple $100,000, you take it. So you could defer a $10 million gain as an example, right? And then take a few $100,000 out every year and pay taxes on it.
Yeah.
You know, and that would be the way of not taking that huge hit in year one, but you're giving up control of the money, and you're basically essentially putting a trustee, you know, financial advisor trustee in charge of your probably your the bulk of your net worth. So,
Right.
you know,
Right. We also had the opportunity this year, Ted. We have a new partner in oil and gas. And that's been a fantastic investment that's yielded an offset to active income. Because we have a lot of investors, right, who are, you know, high income earners. So they're able to offset with that. And then they have a 1031 exchange set up in the oil and gas fund for 2023 lined up. Any thoughts around, you know, using oil and gas and energy type investments to offset active income?
yeah, I mean, look, I hear a lot about that. I personally don't know very much about that at all. I'm pretty real estate centric, and I sort of kind of like it that way. You know, the same way so I think if you want to do that, just know the facts, like know what you're getting into, and maybe find somebody who is like I'm an expert in real estate. Find somebody who's an expert in oil and gas investments, and put them on your team. Even if they're not your primary tax advisor, they could help somebody like me, because that's what I would do with a client. Like somebody said, hey, I'm getting into oil and gas. I'm like, okay, let's find you an expert. The same way we might find you an expert on crypto or something like that. You know, dealing with some people who have cannabis investments, right? Okay, let's find somebody who knows that business, because there's two things that I think everybody who's listening needs to understand. One is you can't, if you're a specialist in everything, you're a generalist, right? And then you're a specialist in nothing, effectively, right? Because you can't, like, you know, you can't know everything about everything. It's not possible, right? So what I would suggest is that if you, whatever asset classes you want to invest in, you find somebody who is an expert in that arena. Just the same way people who do real estate search me out, there are people who are experts in each one of those things, and they should be on your team. Because and like, I have no ego about working with other professionals, right? Because the goal is always what's best for the client. Does that make sense?
Yeah,
Because you can't
absolutely.
possibly know everything.
Right. No, that makes sense. And we talk about that as part of our overall wealth strategy, is really building a team around you, right, to support you. So, and you want a team of specialists who understand their, you know, particular domain expertise, right? So you can get the most value.
Yeah, I think everything is about, I mean, these days, I think everything is about, you want to build a great business quick, be a specialist at something. Know
Yeah.
everything about one thing, and then don't worry about the rest of the stuff. People approach me all the time about, doing tax work for cannabis businesses, doing tax work for, other types of businesses. Maybe I'm just an old dog who can't learn a new trick, but I tell people, look, that's great. Let me refer you to somebody who knows that business, right? And I'll even, sometimes if I don't know somebody, I'll search them out and kind of qualify them for the people. But I won't take on something that's completely out of my realm of knowledge.
Yeah, makes sense. So Ted, we have a lot of accredited investors in our audience, right? People who are getting into syndications, private equity. What would you recommend in terms of, let's say, your top 3 tax strategies that you could recommend to that type of profile?
Okay. So the first one is just recognize that if you're going in as a limited partner, right, and you're investing in a syndication, that especially if it's a real estate syndication, right, and they're promising you bonus depreciation, that you really need to kind of like the idea of tax-free cash flow and not so much work is you may not be able to take the bonus depreciation if you don't have other capital gains from real estate or other active rental income, right? So just kind of get used to the idea that effectively what you're doing is you're building tax-free cash flow, and that tax-free cash flow is actually lowering your marginal tax rate. Okay, so if I make 100, so if I live in California, and I use this as an example because the math is really easy. If I live in California and I work in tech and I make $500,000 a year, right? I probably pay about $200,000 in taxes, 40%, right? Let's say I'm able to use the money that I've accumulated from making that kind of money every year, and I start investing in syndications, and I build an extra $100,000 cash flow from syndications, right? So now I make $500,000 from my job, I make $100,000 in passive cash flow. So I really make $600,000 a year, but I'm still only paying that $200,000 in taxes. Why? The extra 100 is not subject to tax normally under most circumstances, right? So what did I just do? I just lowered my marginal rate from 40% down to 33%, right? So understand that, and understand that building a pool of those kind of investments to bring in that tax-free cash flow is actually a good thing, right? Even if you can never take the depreciation. The other thing, though, is if for people who, especially business owners, who are not maxing out their like 401ks or their set plans or whatever for their businesses, if I've got this pool of money, let's say I'm in that exact same situation as if I've got $500,000 from a business, and now I've created this $100,000 of extra cash flow. Well, maybe I can't, I'm getting that tax-free, right? But then if I take 50 of that and I max out my set, which I hadn't done before, right? My self-employed pension plan. Well, not only did I create not only do I have $100,000 of tax-free dollars, but I just created a $50,000 tax deduction with that money. Does that make sense? So
Yeah.
that's like a double whammy, right? So now let's say I've done that over a few years. So this will be the third one. Let's say I've done that over a few years and I've created this let's call it a self-directed SEP or 401k or retirement plan, right? So now I can go in and I can invest in other syndications using that money, right? And or I can invest in other things that may have other, may have capital gains. Maybe I'm doing some, maybe I invested in other syndications. Now I've got the cash flow coming in to my retirement account also. So what did I do? I created a pool of tax-free dollars, right? That exists over and above my my earned income. I use part of it every year to fund my IRA or my SEP or my retirement plan. And then I invest that money in other syndications that put tax-free cash flow into my retirement fund. Okay. So now I've just triple whammy, right? I've lowered my marginal tax rate by investing in syndications to start with. I'm using it to fund a retirement plan, which gives me a deduction on an annual basis. And those investments are earning tax-free cash flow inside my retirement. Does that make sense?
Yeah, that makes sense. Let me just throw something in there, contrarian to that, and help me with this, right? So if you're putting money into a SEP or really any other type of qualified plan, right? You're deferring. One of the things I just don't like about this strategy is you're deferring taxes, right, into retirement. So yes, you get a break, that year, but I don't know about you, but it seems that taxes are likely going up by the time you hit 59 and a half and you can start taking funds out. Not to mention you have RMD requirements, right, which you have to start to utilize right at that point. So it seems that you're just pushing those you're kind of kicking the can down the road, right? And you're going to pay a higher amount of taxes in the future.
Well,
so
potential, right? But think about this. If I'm making $500,000 a year, right? I'm already in the top bracket. Okay. So that $50,000 deferral from 500 down to 450, okay, is probably pretty close to a 40% benefit, right?
Yeah.
So now I get down the road. So if I'm like, I mean, I'm 50 something. So for me, I saw I have a shorter window till I get to RMD, right? But if you're in your 40s or your 30s and you're making great money, like a lot of these people are, right? You get that long deferral time, right? Okay. But two, when you come out of that, so most people won't, when they come out of that situation, when they get to 70 and RMD kind of scenario, they're not making $500,000 a year anymore, right? They may be, they're probably retired. And so their income is probably going down. So even if rates go up, the amount of money that they're pulling out on an annual basis is probably being taxed at a lower rate than, so think about this, they saved at 40, they're pulling out 15, 20 years from now at 25, right? So they've got that years of deferral, and they've got that arbitrage, that difference between the 40 and the 25.
Right. Right. No, good point. And I think that's where a lot of this comes down to having someone great like Ted on your team, because everyone has an individual, situation, right? And you want to really optimize that, for your own strategy and see what makes sense. But yeah, I'm tracking you there.
Yeah, well, and that's a great, Dave, that's a great point. And that I literally, and I probably should have mentioned this earlier, because I literally start every live presentation that I do with a slide that says everybody in this room is different, and every one of you has a different tax situation, and what works for you might not work for me, and it's all depends on, and I list a whole bunch of different factors, right? And tax strategy is like when you go out and you could buy a suit off the rack, or you can go to a tailor, right? And too many people are doing strategy off the rack, right?
Yeah.
One size fits all kind of deal. When the reality is that tax strategy literally needs to be tailored to the person's specific situation, and to some extent, sometimes their goals, right? One of the funniest things that I see out there, and I'm going to say funny, but it's not really that funny, is people who do so great of a job with their taxes that they can't get a freaking mortgage to buy a house.
Yes.
Right.
Yeah.
Literally, and they have a balance sheet, they might have $10,000 of net worth, but they can't show $100,000 worth of income.
Right. Right. 10 million, you mean? Yeah.
10 million of net
10,
worth.
10 million. Right. Yeah.
They might
No.
have 10 million in net worth, but they can't show $100,000 to buy of income to buy a house.
Right. It completely tricks up the standard mortgage lenders and such.
Right. No, it's 100%.
And the other thing, Ted, I mean, this is really great dialogue. And I think one thing that I've learned as well, as much as you want to take that active role and be proactive, and things, are very customized, right, to yourself, it's also, should be cognizant as well to not necessarily have, the dog, have the dog's tail, right? Wag the dog, right? Or what's the phrase,
Yeah,
right?
I know exactly what you're saying,
The
right?
tail wags the dog, right? So in that case, you're chasing really for that optimization so much that you kind of lose sight of, maybe the upside on a particular opportunity, or again, that strategy that works for you, right? Over the whole life cycle of your, your strategy.
Yeah, well, and so people will ask me, and this is the time of year I get a lot of these kind of questions, like, should I buy something? Should I buy this? Should I buy that? I'll take depreciation. Do you need it? Should I buy a big truck? Do you need a big truck? What are you going to do with a big truck? Does the big truck make you money? Because if you say to me, hey, I'm going to buy a big truck, and by having that big truck, right, this is going to make my work easier, and it's going to make me more efficient, and I think that big truck is going to produce X amount more revenue as a result, and with construct, like I do a lot of construction work also. There's a lot of construction people are into real estate. So it's like with the equipment, do I buy this big, should I buy a loader? Should I buy an excavator? How is that going to make you money? If it's going to make you money, buy it, right? It's still, but because otherwise all you're doing is spending $1 to save 40 cents. So in that scenario, just give the dollars to me and I'll just give you 40 cents back, right? And then we'll worry about it, right?
Yeah.
But that's the thought process is not only, so there's an example of, the tail wagging the dog is people get so, worked up about tax savings that they'll go out and buy things that they don't even need in order to save a couple bucks on taxes, but they don't realize they just spent, $40,000 on something to save 10 grand or 15 grand.
Right. Right. Yeah, it's an important note. Ted, anything also about that, we should advise the audience in terms of, things coming out in the future? I know we've got the Inflation Reduction Act, right, that's coming out, and, anything that, you're advising clients right now about what's going on? Obviously, bonus depreciation sunsetting, I think most of us are aware of that.
That's the biggest one, because I think it has the biggest economic effect. Look, there's probably going to be tweaks along the way. And what I would tell you is to make sure you're working with somebody who is keeping track of that stuff, right? So I'm tracking this stuff all the time. I have the little alerts and whatever set up on my computer so that any news comes out about tax stuff, it hits my computer and I find out about it and I read this stuff, right? So you want to be working, because right now we know some of the some things that have come out of like the newest and latest stuff. One of them is the employee retention credit. So if you're running a business, you had quarters that were your 2020 and 2021 were down compared to 2019, you may want to go and see whether your business qualifies for the employee retention credit, because they did change some of the rules there, right? So that's a big one, right? Because I just amended some 941s for somebody the other day. They're getting like almost $30,000 back for their business from their payroll taxes, right? So things like that, understanding those things, but then just working with somebody you're confident is paying attention, because a lot of people don't, right? A lot of preparers don't, and they find out about it, when they do their required year-end CPE, and then sometimes it's maybe not too late to implement it, but you got to be watching all that stuff. Just as an example, look at the exodus that PPP went through.
Oh, right.
During COVID, right? Where first you weren't going to be able to deduct the wages, right? And it was going to be it was going to be forgiven, but there was this big process, and then they realized, oh my God, we don't have the amount of people necessary, essentially, to be able to even process the paperwork to actually defer these loans, or to make these loans forgivable, right? To forgive the loans. So they said, okay, everybody who got less than this amount, fill out this one-page piece of paper, right? That was the progression. And oh, by the way, now we're going to let you. Now we're not only going to forgive the loans, we're going to let you deduct the wages, right? So that kind of progression, watching what's going on, right? Those kind of progressions make a difference. You need to be paying attention to that kind of stuff. And the reality of it is most high net worth people are, right? Because they're the ones who they got to be high net worth people for a reason, right? They pay attention to stuff.
Great. Ted, really appreciate you coming on the show today, providing so much value to the audience. If anyone would like to, reach out and learn more about what you're doing, connect with you, what is the best place to do so?
Yeah, well, so I have a website, www.landmarkcpagroup.com, and you can learn about our tax strategy. You can get my book, The Tax Smart Landlord, there. we have, there's articles and all kinds of stuff there. So that's a good place to start. There's also a work with us page where you can go and you can fill out a little form that tells us about you, and then set an appointment to have an intro conversation with me about your situation. And look, we don't take everybody, because there are people who we really feel like we can make a huge difference with, and those are the ones we take. And then there are people who, like, if you're a W-2 employee who's investing in syndications, and you don't qualify as a real estate professional, you're not active in the deal, so your losses are gonna kind of carry over or whatever. Those people we take on, we look at it from a selective basis, but there's no magic there. So I like to take people on as clients who I can do magic for, right? And I, because there's only so many hours in a day, and you want to try to get the most results for people with those hours. So that's kind of how we approach it.
Great. Really appreciate it, Ted. Great dialogue, and look forward to connecting with you soon. Thanks again.
Thank you, Dave. Thank you. Have a great day, man, and
You
stay
bet.
safe.